I kind of think of my portfolio as a third, a third, a third. I want to be planting seeds with a third of it. I want to be watching green shoots sprout with a third of it. And I want to be in a harvesting phase for a third of it.
So what advice do you have for other women who are current investors early in their career?
Stay balanced. Make sure that you're investing in your career and you're investing in your family and you're investing in yourself.
There's a lot going on in the world today. Where are there opportunities?
I think the greatest opportunity is...
Today we have Hilda Applbaum here. Hilda has been with Capital Group for 30 years. She's an equity portfolio manager based in San Francisco. Hilda, welcome.
Thank you, Mike. Great to be here.
So Hilda, we usually start with how you got to Capital Group, and I'm going to go even further back. And you and I had a chat before we got on the set together and talked a little bit about your family and your parents, and they had a really big impact on you and your childhood. Let's start there before we start talking about the world of investments, because I know it's really important to you and how you got here today.
Thanks, Mike. Yeah, my parents came to the United States after being liberated from concentration camps. They were highly intelligent people, but they came to the United States with barely a high school education, no English, and no careers. And they were very determined to give me the opportunities that they didn't have. They instilled in me a real love of learning, ethic of doing the best that I possibly can, and they modeled resilience and perseverance. And that was really important to me later in my childhood because I lost both of them at a young age. So my mom passed when I was 11 and my dad when I was 17. So their modeling of resilience, perseverance, and enduring and moving forward really carried me.
Yeah, and you started as a teenager in working just to save money for college.
I did.
Yeah, that's a lot of resilience. That's an impressive start, and where you've ended up today, by the way, is just a remarkable achievement. We'll get to that, but I think that's an important foundation for the conversation. So you didn't start as an investment professional per se. You started more as an economist, which for some is a pathway, but not for most going in that direction. Maybe talk about why starting as economist and then why the change.
The why the change was really, in one word, serendipity. I was hired to the Farm Credit Funding Corporation as an economist in the mid-'80s, and that was the beginning of a terrible period for the agricultural sector in the United States. Farmers were heavily laden with debt, interest rates were really high, and commodity prices were really low. And their only access to liquidity was our commercial paper program. And therein lied the potential for the next crisis, as we were setting up for a tremendous asset liability mismatch. We were ostensibly funding the banks with 30-day commercial paper to fund 40-year land loans or 7-year equipment loans.
Small mismatch.
A little mismatch. Yeah. And what wound up happening is I was tasked along with a couple of other folks to come up with an anticipated liability hedging program. And then I was offered the opportunity to actually implement the program that we had come up with. So that introduced me to the fixed income markets, trading, and started my career in investments.
I've heard you say it in different audiences that opportunity is born out of distress or challenge. So distress was 1987 and the stock market crash. And you were, I think, joining CalPERS at the time just after the crash. So what was that like, and how did your first period of time at CalPERS go when the stock market, I think it lost 20 some odd % in a single day? How was that?
It wasn't a lot of fun.
I can imagine.
Actually, I was hired by CalPERS in August of 1987, but my start date wasn't until November, and this little crash happened in between. I was actually hired into the fixed income group because of my fixed income derivatives experience, but when I got to CalPERS, they had 2 portfolios of equity securities that were brought in-house. But they realized post-crash, when the portfolios did far worse than the market itself, that there were things in that portfolio that they perhaps didn't understand. So my first assignment was actually to comb through the portfolios, analyze what was in them, and come up with some recommendations of how to dispose of those portfolios. And eventually the objective was to index those portfolios. And indeed, there were some unconventional investments in those portfolios. There were some long-dated options, there were convertible securities. And in analyzing the portfolio and coming up with the recommendations, I approached the chief investment officer and said, these things are too cheap to sell right here. They represent a great deal of opportunity. And she was, that's great. There's only $100 million of those. If you can grow that to $1 billion, then you are hereby designated as our convertible securities portfolio manager. And so in addition to helping to index the rest of the portfolios, I became an active manager of convertible securities.
Well, that's an interesting way to become a convertible bond manager. You, and we talked at the beginning about your upbringing, and you learned the value of a dollar very early. And now you are widely known, I'll embarrass you, as an income guru. How did those early years influence how you are an investor today?
You know, as I mentioned, I lost my parents at a young age. And the little bit that I inherited really had to take me through finishing high school and helping to pay for college. And actually, what my dad left me were a couple hundred shares of AT&T stock, Exxon, and I think Braskem. And what became really obvious to me was I needed the income. I needed to preserve as much of that principal as I could, and I needed to grow it.
And you were 17 at the time.
I was 17 at the time. And actually, the portfolio my dad left me, it wasn't very large, but it kind of modeled what I needed to do. I needed income and I needed safety, and I couldn't tolerate a lot of volatility. As a matter of fact, I have this image of my dad. He would get the quarterly check, dividend checks in the mail, and he'd sit at the kitchen table, had a little notebook, and he'd record the dividends that came in before he deposited it in the bank, actually going to the bank and making the deposit.
Do you still have that notebook?
I don't.
Oh, God, that would be a wonderful thing to still have. Yeah,
it would.
Well, I'll tell you, you do learn early on through adversity some things that carry you forward. In your office, and I will fast forward to the office treasure hunt because I think it's appropriate relative to what we're talking about. And Mark is going to hand me this ceramic, heavier than I thought. Thank you, Mark. Piggy bank. So obviously important. It's in your office. Not a lot of folks. For those listening, because we have both viewers and listeners, for those listening, I have a basketball size, heavier than a basketball, ceramic piggy bank. How is this important to you, Hilda?
So I was given that by Janet McKinley, who was a principal investment officer in one of our income funds. And she came into my office one day and said, I know you're going to say you're not ready, but I know that you are. I plan on retiring, and I think you are well positioned to take over my position as the principal investment officer in the income fund. And our income group is lovingly termed the yield hogs because we're piggy for yield.
Yes.
So that was a symbol of her handing over the mantle. I did have a lot of experience in the income fund, but she was right. I didn't feel myself to be ready. So when I look at that pig, I not only remember the confidence she showed in me, but I try to remind myself that it's a good idea to sometimes take risk, dig deep, and even when you're not 100% sure, make that effort and try something new. It's also a really good reminder to me to seek the potential in others. She saw something in me that I don't know that I saw in myself, and hopefully I do that with others as well now.
It's a great story. And what year was that approximately?
It was about 20 years ago.
20 years ago. Thank you. And you've been a great steward of that income strategy for a very long period of time. So let's get into your investment approach. Some portfolio managers hold very concentrated portfolios. Some are more diversified. You describe yours as barbelled and hedged. So for the layperson, what does barbelled and hedged, as you think of your own investment process, mean to you?
So investing for income and low volatility, It usually means that I want to be diversified. I don't want any single portfolio holding to sort of torpedo my investments. And investing for income kind of takes me to an interesting part of the investable universe, which is high income producing stocks, which tend to be cyclicals at the low point of their cycle, turnaround situations, or lower growth stories that are highly cash flow generative. And you wouldn't want all of your investments in cyclicals. I kind of think of my portfolio as a third, a third, a third. I want to be planting seeds with a third of it. I want to be watching green shoots sprout with a third of it. And I want to be in a harvesting phase for a third of it.
That's an interesting mindset. And that third, a third, a third. So that's by percentage market values. It's not necessarily number of holdings.
Correct.
Okay. And in the third, where you're looking for more growth, when will you be, I would say, shaken or scared out of a position of a holding in a certain company? When will you say, you know what, I'm still an income manager. This is the growthier part of my portfolio, but enough's enough. What causes you to say that?
It tends to be very gradual. So I'll sort of leak out those holdings. But for me, when something is well less than half of a market yield, it really doesn't belong in an income fund.
So you look at a broad index yield, and if something is less than half of that, that's sort of your standard for it's not supposed to be in this strategy.
Right.
That's a really interesting mindset.
Yeah. The other thing is P. You know, if there are holdings that, especially in a turnaround situation, that you might be able to buy with some amount of uncertainty, something with a single-digit price to earnings ratio, and sometimes that will double, sometimes that will triple, and I'm not sure it's 3 times as good a company in most cases.
Got it. Okay, that makes sense. A lot of our portfolio managers and analysts are analysts of company managements. And none of our investment professionals think that's unimportant, but folks have a different degree of just how important it is. So on the 1 to 10 spectrum of it's important to, it's what I focus on most is company managements. Where are you on that spectrum? Is it the most important thing, the management of a company you own, or is it somewhere in the middle?
I'd say it's probably somewhere around a 6 or a 7.
Got it.
So good managements can't take a bad business and make them great businesses, but they can take decent businesses and make them great businesses. And you can have a great business that a management can run into the ground. So I find it pretty important.
And what if you're into a stock and it's a big holding for you? I know you're diversified, but let's just say it's at the upper end of your holdings in terms of market cap or weighting. What will a management do that causes you to lose confidence? Is it capital allocation? Is it getting involved in expensive hobbies? What do managements do that cause you to lose confidence? What are some of those red flags for you?
So if it's already a holding of mine, I would say a management team that becomes increasingly disinterested, self-satisfied. So it might be a CEO that all of a sudden decides living in a different state is more important than being in the same state as the headquarters. Also, it begins to become a red flag when a good company and a good CEO starts using the pronoun I a lot more than we. That suggests a certain amount of hubris and self-satisfaction and maybe lack of diligence that maybe was present when I initially invested in it. A third red flag for me is when a management or CEO becomes overly interested in the size of my holding or in the firm's holding. So a management team that comes in and first thing out of their mouth is, I see you hold less of this, or why don't you hold more of this? That tells me they're looking and managing to the wrong thing. Their job is to manage the business. Mine is to manage the investments on behalf of our shareholders.
So you don't want them overly focused on their shareholder roster. You don't want them overly focused on your quarterly disclosure in terms of how many shares Capital Group holds. You want them operating the business.
Exactly right.
Yeah, I think that's an important focus, to stay focused on growing shareholder value. And if you do that well over time, things will work out in terms of your multiple and your market cap.
Exactly.
New analysts starting out, like all of us, make mistakes. What advice do you have for analysts who walk into your office in San Francisco and have that story? And that story is different for everyone, but that story could be, I invested in this name and told others they shouldn't. It's down 30% in the first 6 months. What do I do? Or what are the kinds of, what's the advice you give to new analysts who run into some trouble?
Yeah, I'm a big fan of blank sheet of paper. So first thing I say is go back, forget what you've recommended, do the analysis. Would you recommend it again? And if the answer is yes, then be present. Go back to the folks that invested alongside of you or the ones who didn't and you'd like them to. And don't shy away from explaining what didn't go exactly to plan. Be present. And if you decide blank sheet of paper, you wouldn't invest in it, own it. Go into their offices and say, this is where I went wrong, or this is what I didn't understand. This is what I've learned, and live to fight another day.
Stock picking is obviously very important. It's what we do, but there's also a broader portfolio construction mindset, especially in an income portfolio. How do you think of that? The bottoms up stock picking, we know companies better than anyone. We knock on the doors, we know managements, and all of these different companies that I own are in a portfolio. And how is that portfolio as a whole acting? How do you think of that mindset?
I came to the business as an economist initially, so I try to remind myself not to hone too closely to that skill set because it's hard to get the macro right. That said, I probably think a little bit more about the economy, the macro environment, geopolitics, a little more than average. And also because a lot of my holdings are cyclical holdings, you do have to have an opinion on where you are in the cycle, but you don't want everything to be on one side of the ship. You know, that causes the ship to tip over a bit. So I want to have some stable companies, some income generators, some ports in the storm, and then some paprika and some spice in terms of
back to your third mindset. Where are you seeing opportunities today? Because you mentioned geopolitics and macro and volatility. There's a lot going on in the world today. Where are there opportunities?
So because I work for such a tremendous organization that has a long-term investment horizon, long-tenured analysts and portfolio managers, I think the greatest opportunity is looking for diamonds in the rough right now. There are some great companies with good bones that perhaps have stumbled a little bit, but the business itself are intact. And where boards have had the foresight and the intestinal fortitude to change out managements, look for competent managements that have both experience in turnarounds and also in that particular business, I think that's where I can bring and we can bring some unique skill sets.
And when you look at income, there's a lot of companies outside the U.S. that generate income. So inside the U.S., I think there's something like 150-ish companies with greater than 3% dividend yield. But outside the U.S., I think there's 800 or 900. How do you think of the global opportunity set?
I have increasingly been interested. That has increasingly been the wrong thing to do until very recently. So valuations are more attractive than inside the U.S. Yields are higher. But again, back to the backdrop of economic growth, outside the U.S., they've had flagging economic growth, but we're, again, beginning to see some green shoots, beginning to see some changed mindsets, and so I'm gaining in confidence.
Lessons learned, you talked about some of your advice for younger analysts. Which advice do you wish you had back then, whenever then was, you determined the time period in terms of what you needed to do better. What were some of those early lessons learned that you wish someone had told you?
So I think that the biggest lesson and the greatest mistakes was when I didn't stay in my swim lane. Investing in things that I didn't understand or that were contrary to my nature and we all bring our personalities to the investment process. So for me, I'm conservative by nature, I'm conservative by history, and shooting for the moon is not in my...
Let others do that?
Let others do that. And not that that's not a fantastic way to invest. It's just not what I do well. And when an investment that I have that I don't understand that runs contrary to my personality, I'm easily scared out of that position when things don't go exactly smoothly. So if I invest in something I understand and there's been a pullback, and I can reevaluate and decide whether it's time to invest more or get out of Dodge. But when I'm not quite certain, when it's not within my comfort zone, doesn't work.
You know, I've heard others describe that as getting involved in hobbies in the portfolio.
Well said.
And so, you know, when your investment style is so disciplined after doing this at Capital Group for 30 years, do you still find yourself 30 years later getting enamored with that one hobby that you say, you know what, I know I don't do hobbies well, and I know I get scared out of these positions quickly, but this one's different this time. Do you still fall into that?
I do indeed, and it's been especially true in the last number of years as the market has become narrower and narrower. So missing those opportunity sets has felt almost foolish. And so it's really not easy to overlook those and not take a second, third, and fourth look and maybe, be tempted to dabble a little.
Well, the market's been coming your way, Hilda. The market, those green shoots you're talking about are very real, and your style is in style. Your investment edge, I referred to you, you wouldn't say it about yourself, but I referred to you as an income guru. But what is your style? What's your investment style that's unique? What's your edge?
I'd say it's equanimity. And what I mean by that is staying calm and even-keeled. I think it's really easy to either chase stocks that are highly valued because you've been left behind, or hate sell a stock when they turn down. And it doesn't mean that if stock is turned down, maybe the right decision is to in fact sell it. But I think you want to reanalyze back to that white sheet of paper and make a calm, level-headed decision and not just say, I can't stand looking at this anymore. I need out.
So would you describe yourself as an unemotional investor?
I try to be an unemotional
Aspirationally?
I'm a secret nail biter, but
I'm an overt one. So there you go. But you do seem to be, and when I watch you in meetings, when I look at what you do in your portfolio, you seem to be calm in your approach.
I try.
Mentors. Can you share with us one or two mentors that had a impact on your career? And you mentioned one already.
Right.
Who else has had an impact on you? I know you've had such an impact on others, and I want to talk about that, but who's had an impact on you?
Yeah, so I'm actually going to go back to Janet McKinley, not so much because she gave me the opportunity to be a PIO, but more so...
Principal Investment Officer.
Yes, thank you. But what she modeled, I remember back in the late 1990s, she was featured in a Wall Street Journal article. There were two income portfolio managers, and the other portfolio manager was crowing how he was outpacing not only the income universe, but other funds more broadly, because he had shifted and he had pivoted and he was invested in tech and telecom and media companies. And Janet stuck her ground and said she continued to believe in the income philosophy and the objectives of the fund. Less than a year later, that other fund had imploded. So
was that right before the dot-com burst?
It was indeed.
Yes. So late 90s.
Late 90s. And what that model to me is, again, that swim lane idea that funds and investors invest in things because of the stated objective, and staying true to that is really, really important. Her predecessor is another mentor to me. He actually, George Miller, who unfortunately very recently passed, had a hand in my hiring. And what he modeled for me was put the analyst first. Don't put yourself first. He would say, the perfect is the enemy of the good. And to that extent, he would ask an analyst for their second and third best idea.
Mm-hmm.
And, betting on the philosophy that a rising tide lifts more than the best ship in the waters. But what he was really modeling is put that analyst first. You'll do fine, but it's really important to encourage and make sure that the analyst gets to invest in their very best idea. You can take second and third best.
Yeah, that's interesting because it is a differentiator for Capital Group that analysts don't just analyze,
right?
They invest. And that's a huge differentiator. And it makes them understand risk management and portfolio construction and sizing of different holdings, all of those things they learn when they're guiding others to do it because they have to invest themselves. I've heard some different portfolio managers say that their role as a portfolio manager is to be an analyst of the analysts. And so it sounds like George was giving you some advice on that way back when, of just saying, look at what they're doing and invest in their ideas because they're doing a lot of the pounding on the doors and walking the pavements.
Exactly.
Last year, you were named one of Morningstar's top female investors. So a very big congratulations. I've already told you offline what I wanted to tell you online as well. So what advice do you have for other women who are either thinking about getting involved in investing or current investors early in their career?
Stay balanced and make sure that you're investing in your career and you're investing in your family and you're investing in yourself. Stay healthy because if you run yourself ragged or your life gets out of balance, you don't have the longevity. So take care of all the different parts of your life and it'll take care of you.
I think that's great advice. I think back to earlier in the conversation, a third, and investing in your career, in your family, and in yourself is that third mindset. It's great advice for other women who hopefully throughout their careers will be as successful as you have been at Capital Group. Before we get to the final moment where we talk about what you're grateful for, in your words, why is Capital Group special? Everyone comes at that from a different mindset. And part of the reason I wanted to launch this podcast was to show folks like you and your different style and how you make a difference in their portfolios. But I also wanted to show that the sort of secret sauce of the capital system and how unique Capital Group is as an investment manager. But those are my words. In yours, why is Capital Group special?
I think it's the longevity and the tenure of people here. I think of it as it's not a dating situation, it's a marriage situation, and you're in it for the long term, and you want to make it work. So you want to be kind to your associates, you want to be supportive, they want to be supportive of you. If there's any friction, you want to work it out. Sharp elbows, might make you feel good for the moment, but they tend to make you feel pretty awful over the long term. So if there's conflict, there's incentive to work things out.
Right.
And supporting each other, being kind to each other, encouraging each other, making other people successful.
So competitive to deliver outcomes for clients, but collaborative with each other.
Exactly.
Excellent. Okay. A moment of gratitude, Hilda. I'm going to ask you and it could be professional, personal. I'll share with you, Be Obsessively Grateful, a mug that you get to keep.
Oh, thank you.
Pleasure. We're full of gifts here on this podcast. It happens to be the same gift every time, but we're full of gifts. What are you grateful for?
Well, I kind of stole my own thunder. I'm grateful for all the people in my life who've allowed me to have that balance. I'm grateful to Capital and their culture of valuing balance. I'm grateful to my family, my 3 children and my husband, who been patient with me over the years. But rising to the top of that is really my husband. He himself has a demanding career and does a great deal of travel. But he's been my biggest cheerleader and very supportive of me, even when it works to his own detriment. So I'm very grateful for all those who've allowed me to have that tremendous balance and success in my life.
Well, we're grateful for your husband as well in that regard, because that support of you has helped you be here for 30 years and counting. We're fortunate to have you here. All of our investors in our flagship income strategy are lucky to have had you at the helm. And thank you for delivering for them every single day. So we appreciate you.
Thank you so much.